Hey, everybody, it's Brooks York and Sterling Smith with AgriSompo North America's Edge Group, bringing you a special report this time around. And this time around, it's not like the ones we've done in the past, Sterling. The last couple of years when we've been able to broadcast these, it's been because of a market increase in prices, something unexpected. This time around, not quite the same, and we've had a lot of concerns from agents and farmers, and so we thought we'd take a few of your minutes today and really talk about why we're in the place we're at. Is there any hope out there, and what indicators to look for on making these new crop sales? First of all, let's recap where we're at. If you go back to the discovery periods as applies to crop insurance, the projected pricing periods, in February we had a December corn price of $5.91. Just a few moments ago, we were trading around $5.18. That's a 12% decline in a fairly short amount of time, something that we're not accustomed to. And we are in May, which is generally a volatile period. That's one thing to keep in mind because volatility works both ways. Soybeans, actually a little bit more severe situation. For most of the country, our discovery period was $13.76. Of course, that's November futures. We're down 14% right now, all the way down to $11.79. And going back, we did a lot of meetings over the wintertime in sales season, and one of the charts that I pulled up, and Sterling usually criticizes me on this one. Sterling, I use this too often. I know. It's my go-to chart, but I think it's very, very telling. One of the things that we talked about were these situations where we essentially get very, very short on supply. And history tells us in this chart, going back to 1900, this was put together by Purdue University, that it generally takes about 4 years for the market to adjust itself. You can kind of see examples back on the left side of the screen, post-World War I, post-World War II. The 1970s were really strong. And, of course, these are adjusted prices for U.S. corn revenue on 1 acre. And probably not quite up to date with all of the inflation we've seen over the last 12 months, but nonetheless, it tells a story. One that a 4-year period that we're all familiar with was the ethanol boom back in 2010, 11, 12. We saw those 4 years that were really good. And then all of a sudden, the last 4 years have been pretty strong. Starting in 2020, where we got this new corn customer named China stepping into the U.S. market. In 21 and 22, we had prolific demand, and we also had some shortcomings when it came to supply. And when I talk about supply and demand, Sterling, we can kind of sum up our situation, these big percentage drops. And it's not something that maybe we didn't see coming. It's something we certainly forecasted in the winter meetings, maybe not this rapidly, maybe not this soon. Tell us why we're where we are at today.
Well, this is the WASDE balance sheet looking at 22-23, which is old crop, and 23-24, which is new crop. And the big number right here is this ending stocks number. Right now for old crop, we're at 1.4 billion bushels, which if we think about a gas tank and think in terms of the smaller this number is, the more bullish it is for price. 1.4 is definitely something that puts risk premium in the market. It keeps prices buoyant. Now, as we move from 1.4 to say about 1.8, we're neutral, meaning the market doesn't have a lot of bullish fuel. It doesn't have a lot of bearish fuel. If we go over 1.8 and here we're at 2.2 billion, we now have bearish fuel, meaning our corn supplies are much larger than demand. Our stocks to use ratios are going to be tighter, so no one is going to be willing to pay up for this corn. And what's driving this? There are two big things here, and this is not set in stone. The first thing we need to look at here is yield per acre and our total production. See, for 22-23, we yielded 173.3 bushels per acre and produced 15 billion bushels of corn. Moving over to this year, this yield number at 181.5. Now, this is not a scientific number. This is a statistical number. This is the USDA basically drawing a line on a chart and predicting what yields are going to be. That would be the biggest yield that we ever had if that were to come to fruition on the January report. and bigger not by a little bit, but by 4 bushels an acre. So this number is the number in question, the first number.
Sterling, if I can jump in here real quick, that ending stocks on 23-24, that 2.222 billion bushel up there, I want to make it clear to everybody that is a projection for what we will carry out, not this August, but the following August. So to your point, lots of puzzle pieces here. And one of the big ones is that 181.5 in the yield. We would need to yield that on a national level.
Exactly. And we also need to make sure we have the same level of harvested acres as well, which make sure to join us on June 30th for our acreage report, because that will be a big number. Given the weather that I've seen and the crop progress going on, there's no reason to think we're not going to hit some big acreage numbers, because the planting conditions have really been quite good. The second issue, we come down here to exports. Last year, we're right now at 1.775 billion bushels of corn. Now, this number can still change. It can go up if we see better export sales. It can go down if we have a problem with exports. And that in turn will add to this number, the ending stocks for this year, and directly into this number. Now, for exports for the coming year, we're expected to be at 2.1 billion. That is a noticeable and material improvement over what we saw in 22-23. Now, again, keep in mind these numbers for 23-24 were all basically created before 1 ounce of soil got turned, before any export deals came into place, or any currency fluctuations. So this is a projection. This is a guess.
All other numbers look stable. That's good. We got good domestic demand. We've got good demand in ethanol. And that export, Sterling, boil that down. Can a person really simplify that down to a little less China demand than anticipated and a little bit increase in maybe what Ukraine was able to ship over the last 12 months?
Those are the first two big major variables. The third variable is our number one customer, Mexico. How much corn are they going to take in? And there's been some trade row and some talking going on, but I think they're going to remain as a consistent consumer. If we can see less corn coming out of the Ukraine, that will improve the global situation, will tighten stocks up. And the Ukrainian crop, basically, the Ukraine, just view it as Iowa, more or less. And so their crop is probably going to be smaller. That means less corn goes into Western Europe, coming out, Eastern and Western Europe, coming out of the Ukraine. And that does create the potential for some exports losses in China getting made up elsewhere. Also, our other big customers, for example, Japan, if we can produce a lot of very high quality corn, that can entice some additional interest from there and from South Korea.
Sterling, I don't want to take a lot of minutes on this update, so let's take a look at some price action charts, and then let's get specific as to why the sell-off. And I think you're going to lead us to spec funds when we have that conversation, but let's look at exactly what we're dealing with here.
Okay, this is a chart of old crop corn. This is where the funds mainly participate. They want to be in the most liquid areas. Now, the first problem came up, we can see right here coming into February, and we're starting to approach the expiration of the March futures contract. The funds were long a lot of March corn, along a lot of old crop corn. That position in March had to be blown out. They had to get rid of it. Now they have two choices here. They can sell it and just not be long that corn, or they can roll it into July. For the most part, they started exiting those longs, and that created downward pressure coming right in here to expiration day. Now this is July corn, and we had some good Chinese demand. We saw some flash sales. Market perked up a little bit. Then the Chinese came in, and all these nice flash sales we had in here, those went away. They canceled them, and prices slumped. And then we come in here, and we had our WASD episode where the USDA confirmed, for lack of a better phrase, Captain Obvious, that yes, we're going to have more grain, and boom, we collapsed. Now we're starting to do better. And part of this is being driven by weather. That 181.5 yield is price to perfection, meaning if we are perfect, we can, in fact, yield that much. The reality is sitting right here, and the state of Nebraska may take the hit to help the rest of you all out. We have weather problems here. We have a serious drought going on with a hangover from last year. We are already 3 inches behind for the month of May. For the month of May at Offutt Air Force Base, we are going to pick up exactly a 1/4 inch of rain for the month of May. And we're
Wow.
falling into a weather pattern that can be a problem. And yeah, in the central Nebraska, there's a lot more irrigation. As we move further east, that area, there's not nearly as much irrigation. It's a lot more dry land. So that is already going to put pressure on that yield number. So we are going to be extremely weather dependent to get to that yield number. Now, I'm not a meteorologist, but I could play one on TV. We do have a low level jet stream that is actually pushed south, and that's putting all kinds of water on brooks. This does create an environment where we can see a blocking high pressure ridge come in, where high pressure moves in over the Dakotas, and that turns into a massive heat pump that will pump hot air from Texas right over into Nebraska. But more importantly, what happens in Iowa? If this drought begins to spread to the east, we already have dry conditions in part of Iowa. We have a little bit along that I-74 corridor in Illinois, and we have some in Indiana. If that develops, that's going to change the volatility and the complexion of this market noticeably. If that jet stream moves higher into a more normal position, our weather pattern would revert back to something where we would see more precipitation. However, particularly in the western Corn Belt, let's say from Grand Island, Nebraska to Des Moines, from Wichita, Kansas to Sioux Falls, and not really including southern Minnesota, June, July, and August are traditionally, even if we hit normal, are dry months. So we do have a burgeoning problem here that can help move the market. And one thing I want to
Sterling,
point out on this chart,
let's
go ahead.
let's flip to December very quickly if you've got that chart handy. I think that may be the next one. And in just for light of everybody's time here, we'll probably have to speed up the pace just a little bit to try to make this 20 minutes. But one thing Sterling's illustrating there is volatility. Volatility doesn't mean just the market going up. It also means this market going down. Sterling, to your point, May, June, July, where do those fall on the volatility chart?
Well, let's bring up a volatility chart here before we talk about exports and all that and funds. So right here, as you can see in previous years, as we start to move in, as we approach pollination, that's really the thing. We can see an explosion in volatility. Right now, volatility, while it's elevated from the very lows, is still relatively cheap. What this means is options on a relative basis are cheaper, particularly around old crop and moving, closer to harvest. So right now, the market is theoretically, from the way options are priced, quieter than it normally is.
One time period, as we look at this and we paint the picture, lots of puzzle pieces have to fall together. Sterling's done a good job of illustrating that 181.5. We've already got some problem areas in the country. We've got actually a few more replant claims coming in than we did last year from our Great Lakes regions, which are Illinois, Ohio, Pennsylvania, Wisconsin, also from the Southeast. Now, we're on an earlier pace, so that corn gets replanted and those soybeans get replanted at an earlier date. But we are seeing that replant issue, especially in the eastern belt and maybe a little bit in the southeast. So one thing to keep in mind, this market still has to be on its toes. Old crop, we are still tight stocks. Look for some opportunities here over the next 90 days. That's the bottom line. So what we're doing right now is illustrating a time period to be vigilant. As we talk a little bit forward, we're going to look at some clues or some indicators that the market may give us into this time period. But the next 90 days are going to be critical.
Okay, so we're going to go back to the December chart here. The bottom indicator here is an RSI. This is a relative strength index, and it's an oscillator. It measures overbought and oversold. When it's in the green, green means go, means you can buy the stuff, meaning the market has a better proclivity for being bullish than it does being bearish. And this can stay, in the soup for a while. It's not perfect, but it does give us an indication that one, we are getting, overbought or oversold. So make sure you read the daily commentaries, make sure you read to the podcasts, because this RSI, or another thing I use called a stochastic, is in every one of these with the exception of Thursdays. So if you begin to see this white line approaching the red line, or when you read the Tech Tuesday, I say the stochastics are beginning to cross in a bearish manner, that's an indication that the move has become overextended. Because right now we're experiencing a nice technical bounce. We're not really experiencing a rally. We certainly don't have a raging bull market, but this does have the potential to become a little more overextended. And right now, I'm kind of guessing that 540, 550 area is going to be a sensitive area for this market, assuming we can keep moving here.
Sterling, on that RSI, it's really, in kind of common terms, it's a measure of momentum in the market. And specifically what I like to look at, it goes from 0 to 100. If you can get anything north of 60, it tells us the environment is good to make sales. If it's below that 50 mark, you want to stay away from it. And obviously, the higher it goes, the better the environment is to make sales. That gives us a clue. We've identified a 90-day period. Let's watch this RSI. I really like anything above 60 to start sales on new crop corn and soybeans. It just tells us that the momentum is going in the right direction. It makes you feel a little bit more confident in pulling the trigger. It's going to be a tough market because I don't think we're going to like the printed number that we have in front of us. We've been accustomed to selling 7. We've been accustomed to selling 15. And it doesn't feel good even to sell $13.50 and $14 beans. This is a good way to really have a clue that you're selling at the right time.
And one thing about this, if you see it go up above the red line and you start to see it come back down through, that is a serious caution and warning. As you can see, when we came down through the green line here, boom, you get a pop. So if you start to see we've had a good momentum, we're expensive now, that's starting to shift, the market can turn very quickly on that.
Sterling, again, in light of time, let's take a look at this spec fund on corn. A lot of these same parameters and trading rules hold true for soybeans. So we're going to zip through that. RSI is a good indicator for corn or soybeans. Another one is a fund position. Now, this sell-off, we can attribute a lot of this to the fund position over the last 5 to 6 weeks. You can see what's happened.
Right here in February, this is when those March futures started to get liquidated. Now, we're going to have July futures coming up in June that are going to be subject to the same thing, and the fund's hands are going to be forced. They're not going to be able to hold any more old crop. Okay, they're going to have to do whatever they do. They're not going to be playing new crop. That's going to be central. So let's keep that in mind. Option expiration date for the June futures and first notice day. Both of those are big indicators. In fact, the option expiration day, most funds don't like to hold things after option expiration, and they will start to get aggressive immediately after that. So we need to keep that little point on our calendar, and that's going to collide right as we're coming into pollination.
And I really like this. I really like this chart. And one thing we've likened it to in the past, we've had the action indicators. Some of you are familiar with that. We kind of likened it to a fuel tank. You mentioned that earlier. 0 being your halfway point. And whenever that fuel tank drops down below that bottom half, closer to empty, you do not want to be a seller traditionally. We want to be a seller as the fund position moves above that halfway point on your fuel tank and gets closer to full. Again, we may not like $5.70 on December futures. We may not like $5.90 or $6 because of what we've been accustomed to over the last 30 months. But folks, this is a really good indicator to watch. If the funds get long again, it may mean it's a good time to take action.
And one other thing about this year, especially if we start to see some weather shifts, depending on what's going on, to get back to zero, the funds are going to need to buy 767 million bushels of corn. Right now they're short 153. So this can be kind of a relative thing. Getting back to zero might be as much gas as we can get into the tank, and there may be a corresponding rally because they can come right back in here and sell it. So we're in a little bit different situation where you'll hear me talk about short covering rallies. That means the funds are in here buying this stuff back. And if they come in here and buy this back, this is going to create a situation where things are going to be a little bit different. And we need to be attuned and aware of that, because short covering rallies aren't new longs, meaning I believe the market's going up. Short covering rallies say I believe the market has stopped going down, and those are two very different things.
Sterling, let's switch over to soybeans and take a look at the WASDE numbers from May. Now, these WASDE numbers, one of the things that has kind of added fuel to this sell-off is in May, we introduced that 23-24 projection. We talked about it on corn. We're in a little different situation on soybeans currently than corn. Things are tight. I'm not going to say we're out of soybeans, but in a lot of places in the country, we're out of soybeans. Can you go through the WASDE supply and demand situation on beans?
Yeah, the situation here for old crop, we had 215 million bushels for old crop. For new crop, we're at 335. So we are seeing an increase. But here's something where when numbers get small, don't use percentages so much. Think about it in terms of just how many beans we actually have. So this balance sheet, while it's definitely looser than it has been in the past, this is still a fairly snug balance sheet. And here we have a little bit different dynamic going on. One, soybean yields do not have the same risk profile as corn does. We do a better job. Soybean plants are tougher. They don't bend as much as corn. So this 52 number, again, it's a big number. We were at 49.5 last year, but we're probably, as long as the weather doesn't get really out of hand, probably going to be closer to this. Total supply, you can see the difference is basically about half the difference in what we have for ending stocks. So production, again, we're adding some production. Two numbers to watch here. First one, crushings. This has been a fairly static number up until recent history. We are trying to grow our crushing capacity here. We have something good in the export sales. For the most part, they're not very good, with one exception. We had really good export sales this week again for soybean meal. We are going to see very good export sales again next week. I saw the biggest flash sale this week for soybean meal I've ever seen, with 225,000 tons of old crop going to the Philippines. If that crushing numbers can rise even from 2310 to 2360, not that big of a jump, that shaves quite a little bit off this. The other number here is the export number, and this is a little bit reversed from corn. We've been taking off soybean exports, but we have cut the ideas for next year. Now, this isn't that big of a cut. We can move enough soybeans into Rotterdam, into Western Europe to fix this. And some of that we may get some help from Argentina on. So there's a greater potential for this balance sheet from the demand side to improve.
Sterling, I'll kind of add some color for some folks in different parts of the country here. There's opportunity, and we don't want to forget about basis. So Sterling's talked about the increase in soybean meal demands, largely due to organic demand. And then number two, we had a disastrous crop in Argentina. Argentina supplies a lot of that southern hemisphere soybean meal. If you find yourself in this situation, and unfortunately, on the lower Mississippi, we don't see a lot of processing plants. If you go to the Ohio River, you start to see Cairo, Illinois, Mount Vernon, Indiana, Owensboro, Kentucky. If you're in that Ohio Valley, and you've got beans that can come out of the field. There won't be many in late August, but there will be a fair amount in early September. One thing contributing to that 52 bushel an acre is we got off to an earlier start this year on planting soybeans across the country. So we've got a little bit more optimism on soybeans hitting that 52 than we did on corn at 181.5. But back to my basis idea on meal. If you've got a market that supplies meal to the export market, this is be specifically on the river system, you should see some very good basis levels. So if you combine the 90-day period that we're looking at, and you look at RSI, and you look at the spec fund on soybeans, which we're going to glance at before we get off here, and you pay attention to those early beans coming out of the field, I think you can put together some cash prices that are good. And again, lower Mississippi folks can benefit from this. Some Ohio River Valley folks, I think, can get the biggest bang for your buck because of their processing capacity.
I would fully agree. And if I were a producer in that area, I'd be figuring out every way I can to get my beans in as early as possible as a general business practice, because if you can have those beans earlier, you are going to get rewarded for them. That's something that has to do with weather and much Mother Nature. That's not something that's going to really change too easily. Looking at the July soybeans here, you can see the RSI is at 32.35, and it is hugging that green line. And this chart, we haven't had a bounce in soybeans. We've had consolidation, we've had congestion, meaning the market is content for now. Now, if we can continue with a bit of a weather story, and if we can lift corn a little bit, that's going to create a situation where we might be able to get a little bit of a bounce out of old crop beans. And then moving on to November soybeans, again, oversold. We can see we have a pretty good idea what the low price is, what the cheap price is, and we have a descending wedge forming over the last 3 days. A descending wedge is when prices start to point down, but they have a floor underneath. That is actually a bullish sign. So there is, where there is life, there is hope. So there is some potential here to get a bounce. How much? It's going to depend on the weather. But right now we're at 1179. 1225 would probably start to look pretty tasty. If we could get above 1250, we would obviously have something driving a change in the outlook, most likely being weather.
Sterling, I want to take one quick look at the fund position, and then I'll wrap us up with some final comments here. Fund position, not a lot different than what we're seeing on corn.
Actually, it's not been as egregious. You can see that we've obviously had a liquidation with funds, getting rid of long old crop positions. There's still an itsy bitsy net long. I'm guessing right now what we'll see tomorrow's report is it's going to be a little bit of a net short. But the soybeans, the funds are not going to drive big shorts in here. This white line here is from 2019 when we had soybean abundance and a little bit of a unpleasantries going on with China, and that forced them. But as you can see in this chart, they're not as inclined to drive the beans as low. And something to keep in mind with fund selling, we've seen kind of a low watermark with corn so far. Interest rates have gone up noticeably. That means the amount of positions hedge funds can put on is somewhat inhibited. They don't have free money to play with anymore. In fact, near-term money has gotten quite expensive. So that means their ability to pound this and really drive it short and also buy is going to be a little bit inhibited, and they're going to be a little more choosy about how they do things.
Sterling, as we kind of take this thing home, and I want you to add some final thoughts to this after I add mine. I think what we can characterize where we're at right now is the market's telling us it's not a good time to sell. And a lot of people pay close attention whenever we have these extremes. It's not a good time to sell. However, history tells us this next 90 days will be provided opportunities. I really think we have to go back to a 2016, 2019 type of market mentality where we have to move quick. We have to make quick decisions, and that's tough to do, especially whenever we're selling values that are lower than the ones we've accustomed to been seeing. Number one, let's look at that RSI. Look at that strength index. If we see a movement above 50, above 60, and to Sterling's point, if we see something that goes up and comes back down, let's take some action. Second thing is the fund position. Watch them. We want to be a seller when funds are buyers. It's that simple. Sterling does a great job of illustrating this every week. Third thing of caution. I hear this a lot. My crop insurance acts as a put option. And there is some truth to that, but there's also some other things that go into it. Most of the people listening to this have revenue protection. Revenue protection, of course, is not only a function of price, but of yield. At APH, if you yield right with your APH, your history, then it's true you have a put option as the price drops. For instance, if you carried 85% protection and you were in the February averaging period, we're very close to claim territory. However, most of us will yield above that APH. That trend is better for most of us. We have to consider how good our yield is above our historical average. And what that does, it really kind of takes that put mentality out. It's certainly not a put at the projected prices of 591 and 1376. So I guess what I'm saying there is, should the market move from 1179, where we were at moments ago, to $13, don't be hesitant to make a sale simply because your projected price is higher than that. It doesn't necessarily provide you that intrinsic protection as stated on paper. Just one thing to keep in mind. What other practical things besides marketing can you do? I think we got to look at some things here. I think we got to talk practically. One thing is equipment purchases. Equipment has really taken off the last few years. I think I might hold off on making those big equipment purchase decisions until we see where the crop is at, where we've got things sold. Also, land costs. Cash rents aren't going to come down because of one blip in the marketplace, but just realize every appraisal that you receive right now is almost based on two different parameters. It's based on something that might have traded 6 months ago to 8 months ago at a much lower interest rate and a much higher commodity price. I think that's one thing we've got to be noticing, especially if you're looking at buying ground over the next 3 months. It's almost been appraised in a different world, Sterling.
Yeah. And that's where, again, equipment purchases, big capital outlays, and interest rates. The interest rates have moved up noticeably. And here, this is a 2-year, and we're trading at just north of about 4.4.5% here. So we are looking at a high interest rate environment that is not necessarily good for land values, and you're going to pay up for it. And along with that, equipment purchases, if you need to borrow money, it's not that great. And something I'm going to talk about here real quickly is the yield curve. If we look at the top, that's the current yield curve. As we move across from the left to the right of this chart, this is the further you go out in time. Normally, the bottom line is normal, where we see short-term rates are noticeably lower than long-term rates. You can see how that line flows. Right now, they're noticeably higher. That's an inverted yield curve. This will flip at some point when the Fed gets done with their rate hikes. Most likely, the front end of the curve is going to come down. I don't see that long end of the curve really bouncing up. So down the road, I do see, particularly if you're indexed to 2 years, 5 years, or 10 years, the potential for interest rates to come down is there. Part of this is being driven by this mayhem in Washington over the debt ceiling that is driving near-term interest rates up meaningfully, but there is the potential for these to come down. Some points I'd like to add. The podcasts, make sure you're listening to them every day, twice a day. Make sure you're reading the daily emails, because when we get these chances, as Brooks pointed out, they're going to be quick. And quick, I'm not talking, minutes and seconds. I'm talking days or two. We may not see, unless we get a full-blown drought, where you have weeks and months of opportunity. So paying attention. As soon as you're done with the planting, make my stuff your daily soap opera here and pay attention. because we will get these opportunities and they will be quick and fleeting. And make sure you know you have all your tools in place and you're ready to go when it happens. Um, and have a plan in place about what you're going to do.
As always, if you've got any questions, you can reach out to it here at as AgriSompo North America, and we're gonna be with you. Hopefully, another market update prior to that June 30th report we can put out, maybe illustrating some opportunities out there. We just wanted to spend a few minutes to go through our current situation. We know there's a lot of concern out there. Hopefully, we painted a picture of why we're here, and also giving you some clues as to what to look for over the coming weeks. With that,
Yes.
everybody
And
have
one other thing,
a great Memorial Day weekend.
I'd like to add, we have a WASD on June 12th. We will be talking about what's going on. I don't expect any big radical changes on that report, but there will be plenty of things to talk about that. Also, the third Thursday marketing meeting. By then, we're going to be to mid-late June. The picture of the weather, particularly here in the Western Corn Belt, is going to be a lot clearer when we have that meeting. So make sure you attend those because that is going to give us time to talk about a number of other things that we were going to talk about today in greater detail.
All good stuff. We look forward to hearing from you in the future. Everybody have a great Memorial Day weekend, and we'll be back with you in the future.